Good morning, everyone. I just wanted to say hello and welcome. I hear we have over 180 people registered for this, so that's exciting that all of you are interested in accounting, especially on this last day of summer that we have before we head back to school next week. I wanted to take a few minutes to just introduce myself and maybe I can find out a few things about you. Again, I know it's going to be a little challenging to communicate since there's so many of you, but we'll definitely have time for questions at the end. And before we get started, if you could just make sure that you have something to write with, some paper, and another device would be helpful. I'm going to try to make this interactive and try to have you do some work before we end, because I really want everyone to leave with the ability to prepare financial statements and know how to prepare those. My name is Diane Chabes. I am currently an assistant professor of accounting at Rockford University. I worked in corporate accounting for 23 years before I started teaching full time. I got my CPA almost 20 years ago and was a working accountant for many years. And I definitely love accounting. I got my MBA and wasn't sure, what I was going to do. But I got a side gig teaching, and I was teaching a night class, just the general accounting class, and found out that I absolutely loved it. So that changed the course for me. I suddenly discovered I wanted to teach, not work in the corporate world anymore, and how in the world was I going to be able to do that, without a PhD. So it took some time, but I did find a full-time professor position in Rockford, and absolutely love it. It's my fourth full-time year there, so I'm really enjoying it. Okay, so I just wanted to today, first of all, talk to you about what accounting is, what we do. I think there's, in general, some misunderstandings about even that. How you might find the right accountant. From what I understand, many of you are starting the journey towards starting your own business or already have started your business and are working on getting licenses and permits and all of that fun stuff. So how do you, find someone to help you with your accounting needs? Talk about the different areas of accounting and what your needs might be relating to those different areas. Go over some of the basic concepts, like what is GAAP? I'm sure you've heard of generally accepted accounting principles, but what does it mean, for you and your financial statements? And then I want to get into actually preparing the financial statements. I'm hoping again that you will partake in that and be able to actually prepare them before we leave today. And then also something that is probably important to your creditors, how to get information from the financial statements. So we'll look at some companies and say, do we think they're going to continue being successful in the short term and in the long term? How in the world can we do that by just looking at their financial statements? And I will show you some ratios that you can look at to really get some quick information. Okay, so if you have that extra electronic device with you, now would be a good time to get it out. I'm going to try to do a Kahoot with you. So with Kahoot, what you can do is go to kahoot.it, and again, you can do it on your phone. You can even make the screen smaller and just open another tab. But it's kahoot.it. You don't need to set up an account. You don't even need your email address. If you go to this website right here, kahoot.it, and type in this game pin, 7493138. You should get a prompt to enter your name. And there we have Sean, our winner. Gregory, you guys might have done Kahoot before. I'm gonna give it a little bit of time. I might not wait till we get to the 180 threshold, but as many people as we can. And so when we start the Kahoot, you'll need to see my screen, what I'm sharing, and also your device, because it will have the questions on my screen, and then you can enter the answers on your device or your screen. So. Okay, I'm going to give it just one more minute. I know not everyone has an extra device, but make sure we get this many as we want. Okay, so here we go. And again, if you didn't get to log in for this one or set up for this one, there'll be another one at the end of class too, or end of the session. So most of you chose 2.5 million. 1.4 million is actually the correct answer, and we'll talk about that a little more in just a moment. Bianca J is at the top there. So most of you picked 50%, which is the correct answer. Giving everyone a little extra time. I think we've had a few more people join. So 11 of you have. That's a good, that's almost half of you. So that's really good to know. Not that there's a correct answer there. I'm just trying to get a poll. So 10 of you do want to do your own accounting. 6 of you are saying it's false. Again, no right answer there, but we'll talk about that all in just a few minutes. Okay, I think I'm back on the regular screen now. Okay, so an accountant is one who performs accounting. Should be an obvious answer. But the main goal of a financial accountant is someone who prepares the financial statements. And that's something, again, I wanted to focus on in this presentation. I worked in financial accounting mainly. My specialty was real estate. And we'll talk about how important it is in just a few minutes to have someone who has worked in the industry and specializes in the area of your business. There are 1.4 million employed as accountants in the US, and only 50% are CPAs. I'm really surprised that you guys knew that. I usually get an answer that there's a lot more, because a lot of people assume that accountants are CPAs, and that is definitely not the case. When you hire your accountant, a lot of you already have, just keep in mind they do tend to be under a lot of stress. Accounting is a high stress, high turnover field of work. And there was an article that says accountants have the dirtiest desks. I think that's because they are at them so much, so many hours to work in accounting. So what an accountant does is try to sort through everything that happens at your company. So financial transactions are transactions that occur that can be recorded in the financial statements. So something like purchasing furniture for your office is a transaction that can be recorded, right? There was cash or an IOU that went out in exchange for some assets. That can be analyzed and it can be recorded in the financials, and that story can be told through the financial statements. There's a lot of things that can happen to your company that cannot be told. So for instance, if you are paying your bills late and you get a bad credit rating, there's no way to record that in the financial statements. It's going to affect you. It's going to cause you to pay higher interest. It's going to cause you to have a bad reputation, but there's just no way for us to tell that story in the financial statements with the tools that we have. So how are you going to find your accountant? It seems like many of you have, which is great. But those of you who haven't, it's a really good idea to think about getting a full-time or even a part-time accountant or bookkeeper before you actually start business. You don't need a CPA by any means. You need someone to enter your transactions and be a really strong bookkeeper. You will need a CPA when you have to do tax returns or need an audit. That's what CPAs focus on. But I think as I was working as a CPA in the real estate field, there were many times when, you know, there were undegreed accountants, there were accountants with degrees that didn't have their CPAs. The trick was knowing the industry, right? So you want to get an accountant that knows your industry. If you're opening, for instance, a restaurant, you know, don't assume that a CPA who does taxes is going to know anything about the restaurant business. You need to find a bookkeeper that has worked in the restaurant industry and knows that field. Some ways that you can get that, and again, as many years as possible in your industry is key. So if I look at the financial statements of a manufacturing firm, I'm not going to be able to tell you as much as I can about, you know, a property management firm. I worked in property management for probably 17 or 18 of my 23 years. And I can look at a set of, you know, property management financials and immediately say something's wrong here. You know, I have a question about this number. But that is not the case for pretty much any other industry for me. So it takes experience and some education to really be an expert. Um, excuse me. You can look for part-timers or retirees. That's a big thing now, is people who've kind of left full-time work but are available on an hourly basis. And there are some recruiting firms that do that, or you can just, place an ad for it. Consider remote options today. So everybody wants to work at home, including accountants. I think with the pandemic, we just kind of proved to ourselves that accounting can be done at home. If there was any question before, we've definitely proved it now. So consider offering that. I mean, if you don't want someone in your office, every day, it's a great option for people that want part-time work or even full-time work. Outsource it. There's plenty of firms that actually do bookkeeping. I don't want to name any names. I don't want to, promote anybody, but there are small companies that actually do bookkeeping. And again, it's not a CPA. It's not going to cost you as much as a CPA, but they'll be able to handle it. And they will be able to give you someone that specializes in your industry. User recruiting service, I say begrudgingly because I do know that they charge a lot. If you're going to hire an accountant at $50,000 a year, they're probably going to charge you a fee of $10,000. They charge a really high fee, but they will definitely find you someone that has years and years of experience and is the absolute perfect fit. It's almost like a money back guarantee for them to find you the right person. Don't look at bookkeeping as administrative. It is, somewhat repetitive, somewhat tedious work. There's definitely a data entry aspect, but I do know a startup that I had worked for, and they were a real estate company, and they had not hired an accountant, and they had been in business for 2 years. They were sort of depending on their CPA who did their tax returns to do it, but he was not a bookkeeper. He did not enter the transactions on a daily basis. He was entering them, ad hoc as time went by. And their books were so messy, and again, it was a 2-year period. That's just impossible. I mean, I think it's hard to catch up if you don't have someone keeping track of that stuff for a month, let alone a really long period of time. And then I think someone asked about QuickBooks. QuickBooks is fantastic. It's probably the #1 software used by small companies especially, but get someone that knows it. It is user friendly, but if you have someone that really knows it, maybe has the QuickBooks certification or has worked with QuickBooks for a while, they're your best bet, because they're going to be able to navigate and show you things that no one else will. And then ask for referrals. You guys are a great community, a small community, and you have the BACP to help with things. So definitely ask for referrals for accountants. Okay. So as you go along, again, Bookkeeper, I would say, is the #1 need right away, right? You need someone to keep track of those daily transactions, because every little thing that happens as you go along. So from the very first thing, buying a computer for your business, all the supplies that you buy, the minute you earn revenue, those things have to be tracked, and there's a lot involved. It's not just something you can do at the end of the day in an hour. It's something that needs to be handled when you're billing customers, that needs to be followed up on. So if you keep billing customers and never follow up on payment, you're going to run into issues right away. Tax practitioners are the ones that are generally CPAs. They will do your tax returns. Again, you're not going to be able to have a bookkeeper do that. You're going to have to hire a professional tax preparer. CPAs are usually in firms, public firms, but there are big CPA firms and small CPA firms, and you can definitely use one of the smaller ones to save on cost, and also I think to develop, a better working relationship. To be honest, I think they're much more customer service focused, and you'll have the same one each year. If you use a big firm, you won't have the same one each year. Financial accounting, again, is about looking backwards. It's about issuing financial statements that will be read by the outside world. So creditors are going to read it. Investors are going to read it. All of that matters if you're trying to grow a business. So they need to be, professionally done from the start. And then managerial accounting, if you've heard of that, is cost accounting. If you're involved in any kind of manufacturing company, you will definitely be using cost accounting, but it is actually not related to the financial statements. Cost accounting is about, looking at how you produce your goods and coming up with ways to save on costs and make it more efficient. Okay, so some of the rules and regulations and organizations that oversee accounting, and again, this is something that your accountant and bookkeeper needs to stay current on, needs to make sure they have information on, because GAAP, generally accepted accounting rules, generally accepted accounting principles, will be the rules that you have to follow. And FASB is the organization that sets these. So the Financial Accounting Standards Board sets the rules, and then the SEC enforces the rules. And again, you may be just starting a small company right now, and you have no interest in going public or, issuing stock or anything like that. But don't doubt that if you grow fast and you grow big, that you will need to consider those things. So don't, put yourself out of the running by not considering these things in the beginning. SEC.gov is a government website where you can find any company that you might be interested in. And we're going to look at a company later when we do the ratios, and we'll pull it up and see what company you want to look at for that. Okay, so let's get to the actual financial statements and what they look like. If you have an accounting system, or if you're keeping track of your expenses and transactions in a spreadsheet, or however you're doing it, you should have a list of balances, right? You have all of the things that you're recording. For instance, when you put cash in your bank account, there's a way to record that. You're gonna what's called debit the cash and credit. Here it's common stock, but if you have a small business, it's just partner capital, or your capital account. But once you have a bookkeeper that enters all these transactions for you, you will have a list of accounts and a list of balances that, again, tell that story. So tell the story of your company. What happened during the year? What happened with your assets, your liability, your revenue, and your expenses. And those accounts flow directly from your accounting system into the financial statements. So when you prepare an income statement, that has to be the first statement that you prepare. It is just the equation revenue minus expenses equals net income. That is all that an income statement shows. Accountants may make it look fancy and may move things around and may make it more complicated than it needs to be, but all you're showing is your revenue minus your expenses. And this is a very simplified one because there's only one type of revenue and a half dozen expenses here or so. that will grow and that will change, and there could be dozens or hundreds of each of those accounts. After you prepare your income statement, again, you need net income to prepare the next statement, which is the statement of retained earnings. Statement of retained earnings, all it does is show how much of your net income you're keeping. So You have a beginning balance, you add your net income. If you decide to pay out any dividends, that would come out of there, and then you get an ending balance. And that has to be the second statement that's prepared because you need this number for your balance sheet. Last statement is the balance sheet, and we're going to ignore the cash flow for right now. Not that it's not important, but it's sort of separate and not as interconnected and interdependent as these others. So the balance sheet shows the accounting equation assets equals liability plus equity. That is what the accountant spends their majority of time trying to keep in balance, is that equation. And we do it with, again, a series of debits and credits or pluses and minuses or journal entries, which you guys definitely won't need to know if you're going to hire a bookkeeper, which again, you probably will have to if you haven't. But this is the equation that we need to keep in balance because the balance sheet shows the long-term health of your company. It shows what you have as far as assets and liabilities are concerned. And it's the statement that, never goes away. Revenue, expenses, you kind of track those for a while and then they roll into this eventually. This is the permanent statement. Okay. So I want to do an example here. And these two slides are really great. Again, if you're not familiar with financial statements at all, if you never prepared them, these are great examples as to where everything goes and what belongs on which statement, right? So you know that anything revenue related and expense related will go on your income statement. Anything that's an asset, a liability, or an equity will go on your balance sheet. But let's look at a real example of how to prepare these financial statements. Going to switch over. Let me see, I'm gonna my screen. So what I want to do is be able to write on this for a moment. And as you go through, again, you can look at those example financial statements. So what you need to know as someone who's looking at the financial statements and wants to understand how they're connected is what is accounts payable and where does it go? So we can see from the other slide that accounts payable is a liability that belongs on my balance sheet. Accounts receivable, that is an asset. And again, we don't need to know every detail about what these accounts are. Accounts receivable are what our customers owe us. We see that it's an asset on the balance sheet. Accumulated depreciation, I'm sure you've heard of that. It's a tax word, but again, unless you're a fixed asset accountant, you don't need to know a lot about accumulated depreciation. Just know that it's a negative asset or contra asset that also belongs on the balance sheet. Bonds payable, just about anything payable. I'm not going to say always. I never say always in accounting, but bonds payable, anything payable is going to be a liability that goes on the balance sheet. Cash, that's our favorite asset. Everyone seems to know what cash is and where that goes, also on the balance sheet. Common stock. So common stock is one of those things that shows up on the balance sheet. It's one of two things under stockholders' equity. Stockholders' equity consists of common stock and retained earnings. So this goes under equity on the balance sheet. Cost of goods sold. If you are going into retail or merchandising or maybe in manufacturing, you will get to know cost of goods sold very well. But for right now, we just know that it's an expense on the income statement. Depreciation expense. I love it when they give us the answer. Also an expense on the income statement. Dividends. The only place that we saw dividends was here on the statement of retained earnings, right? We pay them out and we never really talk about them again. So they go on the statement of retained earnings. Equipment, that is an asset on the balance sheet. Interest expense, again, they give us the answer. All expenses go on our income statement. Patent, that is if you've, you know, secured the exclusive right to develop something or issue some sort of new product. That is a very valuable asset that belongs in your balance sheet. Retained earnings on January 1st. So the only place that we see that is on the retained earnings statement. That is our beginning balance, and that will go away once we calculate retained earnings. So this belongs on the retained earnings statement. Salaries expense, again, they give us the answer. It's an expense on the income statement. Sales revenue, another one, revenue on the income statement. And then supplies. So that's a tricky one. It seems like it could be an expense, but if it doesn't say expense, we're going to assume it's an asset. Okay. So we had a list of random accounts. We have gone through and identified what each one is and where it belongs, and we are halfway to preparing the financial statements, believe it or not. So once you have identified these, and that's the hard part, again, for someone that's not familiar with all of the accounts, all the types of accounts, and the financial statements. If you've never, you know, looked at any of those, you're going to have a harder time than someone that's, you know, spent some time looking at them or is familiar with the accounts. But so once we identify them, then we can prepare the financial statements. And I believe this is Yoda Company. Okay. So for Yoda Company, when you prepare the income statement, again, it's just that basic formula. As soon as you know what your revenue and expenses are and you've identified them, you can calculate net income. So we identified sales revenue as 36.5. These were our expenses. So we have a net income for the year of 11,000. This is the number that we need to calculate retained earnings. We have the beginning balance that they gave us. We just calculated what net income was, and we identified dividends. So our ending balance is 21,700. Then we need that number to create the balance sheet. And remember, every financial statement has an equation that we're trying to create. The balance sheet is assets equals liability plus equity. We have the list of assets that we identified. Total assets was 83,200. And then liabilities, we only had two, accounts payable and bonds payable. We had common stock, and then we had the retained earnings that we calculated. So total liabilities and equity do equal total assets, which is what we have to have. And again, luckily, you know, if you have QuickBooks or if you have one of those accounting software packages, it kind of goes through this process for you. But the thing is that those software, no matter how good of a user you have entering information, they do make mistakes. And there are things that you need to look at. You know, if you push the button to print these statements, you need to understand what you're looking at and how to, you know, kind of figure out if there's something wrong, you know. And your first thing to look for is, do total assets equal liability plus equity? Because that is the final equation, that is the final sheet. And to be honest, this is the financial statement that your creditors and investors are really going to be looking at. Let me go back to this one. Down here. And I do think that we have time for you to try one on your own. So this is where your paper and pencil is going to come in handy. So try to go through, and again, I don't recommend, unless you're very familiar with the accounts and where they go, I don't recommend just trying to prepare your financials. Try to take these and identify where it goes and what it is. And again, you can look back. Actually, I can't split the screen. But you can also pull up just any financial statements online if you're not sure where something goes. But try it on your own. Just take about 10 minutes and try to figure out what the income statement, statement of retained earnings, and balance sheet is for Vader. He's our competitor for Yoda. Okay, we're going to spend about 3 more minutes to finish the problem. So again, just give it a good try. And if you don't get all the way through, then that's totally understandable. Okay, so let me share. Okay, so this time we're looking at Vader Company. Hopefully everybody at least got an income statement done. As we go down the list, salaries payable is a liability that belongs on the balance sheet. Salaries expense is an expense on the income statement. Utilities expense, also an expense that belongs on the income statement. Equipment is an asset on the balance sheet. Accounts payable is a liability on the balance sheet. Commission revenue, revenue on the income statement. Rent revenue, also revenue on the income statement. Long-term note payable, that's going to be a liability on the balance sheet. Common stock, again, one of those two pieces that are in equity, stockholders' equity on the balance sheet. Cash is an asset on the balance sheet. Accounts receivable, also an asset on the balance sheet. Accumulated depreciation is just a negative asset, belongs on the balance sheet. Dividends, one of those few things that is on the statement of retained earnings. Depreciation expense is an expense on the income statement. And then the beginning retained earnings balance just goes, remember, on that one line item on the retained earnings statement, it's our beginning balance. So then as we look at Vader's financial statements put together, we have, again, the income statement. We've identified everything. It's revenue minus expenses. We're going to have a net loss for Vader of $5,700. He had 2 revenues and 3 expenses. Then we do the statement of retained earnings. They gave us the beginning balance. We're going to actually subtract that income because it was a loss. Subtract the dividends, and we get our ending balance. So again, net income has to be calculated first. It rolls into retained earnings, and then retained earnings goes to the balance sheet. We have total assets of $48,980 and total liabilities and equity balances. So if you got all of that, please type into the chat yes, because that was a really quick turnaround to try to get all these done, especially if you're just learning this. Okay, so one other thing that I wanted to talk about is the financial ratios, and they are very important for to understand what your creditors and investors are going to be looking at, because creditors and investors don't even care about how financial statements are prepared. They certainly don't care about entering transactions or how you're keeping track of things. What they care about is what your financials look like and what kind of information they can get from them to deem how you're going to do in the future. So can we tell the future? No, but we can get some idea in these areas that how your company will be performing, which is pretty cool when you think about it, because it's the business world is so unpredictable. But so there are 3 types of ratios. There's liquidity, and liquidity looks at the short term. So you'll see a lot of things like current assets and current liabilities. And that's going to tell your creditors, investors, whoever's looking at your financials, these ratios will tell them how you're going to do in the short term. And if these are bad, it usually means you can, get a loan and make it through, kind of weather the storm if you have to. They are short-term in nature. Solvency ratios are different. They are long-term in nature. So they will be looking at things like total assets and total liabilities. If these ratios are bad for a company, they are going to most likely make a change. So these are the companies that you see filing bankruptcy, the companies that you see getting new management, the companies that you see changing the way they do things. I remember JCPenney, I think, was one of the retailers that I was watching closely over the years. And they were trying some really different pricing strategies and marketing strategies. They tried different, ownership and I think management over the years because they were having some solvency issues. So these, again, long-term in nature, and you will see these companies in the news for probably maybe merging or going bankrupt. And then profitability. So profitability is just looking at your income statement and saying, are you making money? If you have stock, this one focuses on earnings per share. So they're very different, but when creditors and investors look at all 3, they can get a lot of information, and so can you, from looking at your financial statements. And again, if you don't want to, get involved in the nuts and bolts of accounting and, worry about all of that, this is a way to look at financial statements and get the information that you need. So liquidity ratios include these: working capital, current ratio, inventory turnover ratio is a fantastic one. I think sometimes I've had classes look at Apple and I always think, no, they can't be turning their inventory over that fast. You know, I've seen years where Apple has had a 1-day turnover. So when you do this ratio and you put 365 over it, and if you get a 1, then that means you're selling your entire inventory in 1 day. And I said, oh, that can't be right. But then I go to the Apple store and I can see the lines outside, and I know that it can be right. So and the same with receivables. Those can be very long or very short. These ratios will be industry specific. So for instance, if you're a retailer, you pretty much charge customers as they come in. So you're not trying to collect from them. You're getting payment, right there. So your receivables turnover should be really quick. But if you look at something like a medical office, I don't know about you guys, but I pay my, I wait to see if my insurance is going to pay before I send any money to my doctor. So their turnover ratio is quite different. They could have 4 to 6 months being normal and being good for a medical office, where for a retailer that would be really bad. So you need to look at not just the ratio, but you need to compare it to what's normal with a competitor, what's normal within an industry. Solvency ratios, again, looking at more long-term assets and liabilities, so debt to total assets, cash debt coverage ratio, times interest earned, and free cash flow. And then profitability, again, that looks at your net income. That's just looking at earnings per share, things like the gross profit rate, which also is going to give you, a good indication if you're doing well on covering your product costs and increasing over time. So I wanted to just look at one of these. If I go, so if I compare Yoda to Vader, and I want to look at just the current ratio for a moment. The current ratio is current assets divided by current liabilities. So if I look at Yoda, I'm going to go to the balance sheet, and what's current? Current is the thing, are the things that you're going to use or pay off or get rid of within a year. So equipment is not current. Accumulated depreciation is kind of tied to equipment, so that's not current. Patent is not current. You're going to keep those things for much longer than a year. Supplies are probably current. Accounts receivable, you definitely want to collect within a year, and cash. So the current assets for Yoda are going to be accounts receivable, cash, and supplies. Current liabilities for Yoda, just accounts payable. Bonds payable are always long-term in nature. You usually never, well, I guess it's possible to buy a 365-day bond, but they're usually out for several years. So accounts payable is the only current liability. So for Yoda, the current ratio is going to be the current assets divided by current liabilities. Oops. So 1.7568. Now, is that good? It might be. I mean, I would feel good if I had 1.75 times as many assets as I did liability, but we don't know. We don't know if it's good unless we compare it. So let's assume that Vader is in the same industry. For Vader, his current assets are receivables, cash, and then his current liabilities are payables and salaries. And if we look at his current ratio, we get 5.08. So that's a lot better, right? If they're in the same industry and I can cover my liabilities 5 times, I definitely think Vader is winning. And that's what your bank is going to look at. So if you are Yoda and Vader, they're going to want to give Vader more of a loan, you know, than Yoda. Okay. So that is also something to just think about. Again, creditors, investors, all of them will be looking closely at these ratios because they don't want to think too much about your financial statements or your transactions or anything. They look at this final product and say, you know, how do we think you're doing? And the other thing is that's why it's so important to get a bookkeeper or accountant that can classify things correctly. So if you're you know, having someone that records long-term things as short-term or records assets as liabilities and, you know, doesn't know exactly which account to put things in, then that's going to affect these ratios, right? Because you're going to be off. You're not going to have the correct amount of current assets. So every little, you know, dollar that you record matters. And they kind of, you know, again, need to be kind of scrutinized and watched continuously or you'll get really behind and then there's just like an avalanche that will happen because you'll be too behind to catch up at that point. Okay, so I've seen, I think there were a lot of questions coming through, so I do want to just open it up for any questions that you might have. I don't know if Geraldine was going to read them to me or if I can maybe look at the chat. Does anyone have any questions? So I see Charles has asked, should we have a CPA and a separate bookkeeper? So I think the important part is that you get a bookkeeper from day one, because that is the problem, is that when you get behind, it's really hard to catch up. You don't need a CPA to do your bookkeeping. You don't need a CPA to do your day-to-day accounting. They're very expensive, and honestly, it's a waste. But you are going to need a CPA for things like your tax return and if you want an audit or if you have to be audited. So I think you do need 2 separate people to be doing that because, again, you don't want to pay a CPA to do your day-to-day accounting when you can get it much less expensive. What other questions? Susan is asking if a recording is available. Yes, I do believe a recording will be available. Charles is asking, what is the difference between a tax attorney and a CPA? So a tax attorney is someone that you want to get if you get a notice from the IRS. I'll just be very blunt about that. You know, a CPA can prepare your taxes, file your taxes, and give you planning advice. But once you get a notice from the IRS, you might want to give your CPA a chance to respond, a chance to handle it. But if, you know, they're not giving you a result that you want, or if you're having, you know, some kind of real issue with the IRS, you need to get a tax attorney at that point, probably. Susan is asking, where might I find an accountant for an initial LLC setup? So I would recommend, first of all, getting a referral. I see lots of posts, even like in neighborhood, groups, Facebook groups. If you are, if you have a business that's similar to yours that has used anyone, try that route. Again, last resort would be something like a CPA firm. A CPA firm can actually refer one of the best CPA out of their firm. And for an LLC setup, you might need a CPA, but it's best to get a referral from word of mouth. I know that sounds, well, what if you're new to the area, or what if you don't? But I just think with every profession, that can be a really great resource. Charles is asking, will a bank or credit union provide these services? Generally not. They definitely will not provide tax or audit services. And they generally don't have bookkeeping or accounting services. But there are definitely organizations that do. I know that it's important to be a part of like this community, like the BACP. They have so many resources available, and community groups like that, neighborhood groups, again, are really important when you're looking for people that can help. Any other questions, comments, concerns?
Hi, Diane. We're going to go through the questions.
Okay.
How do we as clients make for the best clientele?
I think that taking this seminar is a good way to start. Honestly, to be able to understand the financials even a little is a gift. And I didn't go into public practice. I was more of a corporate accountant. But having anyone that can just kind of understand a little bit is so helpful to the accountant, because the accountants kind of speak their own language. They're in their own world a little bit. And so it's, it's a little difficult to just the communication, to communicate with clients sometimes. And so that is great to understand the financial statements and how they work. To understand the ratios a little bit is a really fantastic start.
Great, thank you. Do apps like Quickbooks help?
Yeah, so any accounting software is going to be great, but if you can find an accountant, and again, QuickBooks is so well known and widespread, it's not that hard to find someone that's worked in QuickBooks. So if you can find someone that works in QuickBooks, that's fantastic. If you can find someone that's worked in QuickBooks in your industry, that's the best case scenario. Or if you have other, financial, I think someone's saying financial wave. I haven't heard of these actually, but there are so many different types of accounting software. And also, I will say that when I was working as an accountant, it was 50% of my job to be the IT tech person for the accounting software. They can be very finicky, systems. And if you have someone in there that's doing things that don't work or doing something wrong, it can cause real problems. So keep that in mind. They're not as easy to use sometimes as they seem. Some of them are user friendly. I mean, QuickBooks is user friendly. TurboTax is user friendly. But again, if you're inputting the wrong information, you're gonna have problems.
Okay, great, thank you. Another question during the exercise. Can some of these items have applicable multiple statements?
I'm sorry, what was the question again?
Sure. Can some of these items have applicable multiple statements?
Oh, I think that was when we were doing the financial statement example.
Yes,
And
exactly.
no, every account has its own place. So that's something that we like about accounting. It's very organized. So no, if you have, even if you have an account where you have multiple you need multiple accounts. So for instance, when you set up the cash account, you can only have one bank account tied to that. So it's very specific. That cash account is for that bank account, and it only goes in the balance sheet on the cash area. Same with expenses. You don't want to, kind of mix expenses together. If you have more than one bank account, you want to have separate accounts for each of those. But no, each account belongs in it's the same place, every time.
Okay, great. Should we have a CPA and a separate bookkeeper?
That one, you know what? I think I did address that, Geraldine, just a little earlier, but it is important to have a bookkeeper for your day-to-day. So you want to have like a bookkeeper, day-to-day accountant. And again, it doesn't have to be full-time to start. The important things for that person is that they have experience in your industry and that they know your software. Though that would be ideal. And then a CPA will do taxes and audit work. So hopefully you only have to deal with a CPA once or twice a year.
Okay, great. Thank you. A lot of questions if this will be available for viewing. Yes, this will be on BACP's YouTube channel or page, www.youtube.com/Chicago BACP. Diane, I'm not sure if you addressed this question, but I'm just going to ask it again. Do you need a bookkeeper if you're using a software that you are using?
And I think I did.
I think you kind of went over it,
Yeah,
but
I think I kind of
worded a little differently. For a startup business with no history of financial, where can I start?
Well, you've already started, but I think I have to say too, it just depends on what kind of learner you are as well. Like some people, again, need a class. Some people can figure it out from just a general book. There are a lot of kind of short, I call them shorthand books. What are they called? Like Accounting for Dummies, like that type of book that really go through, start at the basics. But if you've never if you've never had any accounting, and I don't think they teach, they don't teach it in the high schools. That's really frustrating for those of us who are teaching it at the college level, because people should have it before they get to college and all that even. But I think this is a good start. But there are local sort of community centers and community colleges that have classes if you really want to take a class. And then also you guys have the advantage of YouTube tutorials, which I think someone built a house with the YouTube tutorial. So you can really find good YouTube information out there on just about anything, I think.
Great, thank you. Is there anything you weren't able to cover in this course that we should get familiar with?
That is a good question. I think for those of you, and I think when we took the Kahoot, several of you said that you were going to try to do your own bookkeeping, which is, it's fantastic. If you can fit it in, then by all means. But I think if you're going to do that, you do need to find a place to keep up on kind of current literature and current ways that things are being done, because things do change sometimes in accounting. It seems pretty straightforward most of the time, but there are times where something will come up and it's, certain things are not allowed anymore. One thing I remember that changed and, kind of caused the company I was at to take a big hit was that the way sales commissions were being amortized, or the way rent was being amortized. So there was a change in that if a renter moved in, they got a free month's rent. And the rules kept changing. So sometimes they said, okay, if a renter moves in and you give them a free month's rent, it's the first month that's free. So you're going to take that loss, that free rent of $1,000 in the first month. And then someone would come along and say, oh, no, you want to spread it over the life of their lease. So you want to show you know, if it's $1,200 in rent, $100 a month loss. And, you know, again, it kept changing and I was trying to stay on top of it, but every once in a while a rule will change. So I think finding sort of places to look that up. And again, that might be through, you know, the BACP or through, you know, sort of your industry periodicals or websites for your industry. That's also something that would be helpful.
Okay, thank you. Another question. I am starting a small business. What do you recommend for a small business that are not operating on a large scale?
I think for a small business, the thing is to not, and I think I said this on one of the slides, not look at it as an admin, you know, administrative task, because that is the thing, is that most of it does seem very simple and very data entry, but then again, staying up on those rules and really being able to look at your financials overall and make sure everything is correct, make sure that they are good. You need an accountant for that, or a bookkeeper. Yes, a receptionist can enter invoices, absolutely. But when it comes to checking if those invoices have been entered correctly, if they have not been duplicated, if they, you know, if you're having trouble with one vendor that either isn't paying, you know, something like that, you need someone that can, you know, has the time and can be analytical about it. So again, if you're just starting off, you know, it's always the cost that's an issue. Stay away from CPAs, find a part-timer. And again, retired folks are great for that. They're always looking, you know, for part-time positions.
Okay, thank you. Next question. Do you think it is good to keep industry ratios to keep to keep comparing your performance with the general standards?
Yeah, so with the ratios, I mean, if you don't compare them, they're actually pretty meaningless, right? Because we can't tell if the ratio is good or not. It might look bad, you know, you're saying, oh my gosh, what if I only have like a 50% current ratio where I only have half the amount of assets as I do liabilities? You know, if your debt is double your assets, you think that's bad, but it might be the industry average. It might be that every other industry is even worse than that, or every other company in your industry is worse than that. So I don't know what, you know, a lot of you are starting different types of businesses, but you've got to get to know your competitors. You need to look at your competitor financials and always be comparing your ratios. Yes, because that's what a creditor is going to do, or an investor usually.
Okay, great. A question. The total assets equal liability plus equity equation. Can you explain that a little more? I'm still struggling with what that means. Also, what would cause that to get out of balance?
Okay. So that is, and in accounting, it's the basic accounting equation. It's one of the first things that we learn that we have to keep in balance. So every time a transaction happens, and let's say you're buying a computer for your business. So the accountant will look at it and say, okay, we bought a computer. What story do we need to tell on the balance sheet eventually? We need to say we bought a $10,000 computer. We want to show that as an asset. We paid $10,000 in cash. We have to reduce our cash asset. So we put in an entry, like a journal entry in the system that will increase computer asset and decrease cash. And then when someone goes to look at that, they see, okay, you have a computer now, you have less cash. It keeps the equation in balance because we've added $10,000 to asset and we've reduced another asset by 10,000. So whatever we do, we want to keep the equation in balance. If we increase assets, we have to have another side to that. And this is, again, getting more into actual, like, what accountants do and why they have to know more than what I was showing you guys. They have to know the debits and credits. Those are what we call the journal entries. That's how we keep that equation in balance. And that is, you know, okay, we bought a computer. This time we gave them an IOU. we're going to increase assets for 10,000 for the computer, and we're going to increase the liability. So we kept that equation in balance on both sides. And then, but I will say too that debits and credits, you know, I think my students just spend years trying to study it and then years doing it, and it takes some time to get used to how to keep that equation in balance. And again, that's why you need a bookkeeper or accountant to help. So what can get it out of balance? So if I put something in backwards, so what if I purchased a computer, and instead of saying, okay, I paid 10,000 cash, what if I increase cash? You know, there's a way to do that in the system, in your accounting system. Instead of decreasing cash, I increase it. It's going to throw off, you know, everything. My cash account will be off at the end. My bank account won't balance. So just recording things in the wrong direction, recording the wrong amounts. So if you, and that stuff you have to look for as well. You know, I mean, you're not always going to know. For instance, if you enter an invoice for the wrong amount, you might not catch it until you're looking through invoices, you know. But there are a lot of things that can throw that off balance, and it causes, you know, your accounting system to go haywire because it wants your balance sheet to balance.
Another question, where can I find competitors' financials for restaurant industry?
So if they are a private company, it's a bit difficult. If they are a public company, you can go to every public company has to file. So if they're public, they have to file with the SEC, and they have to issue their financial statements on sec.gov. If they are private, sometimes they do have the investor section on their website will have statements. So, you know, if they're like a group, like a restaurant group or something, you might be able to go to their website and find individual financial statements from there. But it is, if they're private, they really don't have to put them out there. So you're going to have to kind of hunt and dig. I've had students that worked at a place that was private, and they were just able to get their financials because they worked there. So they, you know, got them internally. You know, don't send a spy, but if, you know, some restaurants will just give them to you if you ask. You know, there's a number of ways for private companies to get them. So it might be better if you can find any kind of a small restaurant that's public, you know, to use that one also.
Okay, we have a kind of a specific question. I established an LLC a few years ago and have been paying taxes each year to maintain it, despite not setting up a subsidiary business under the LLC that has been generating revenue. Is it advised to simply keep paying taxes to keep the LLC in name?
See. Yeah, that is specific. So if you have been filing taxes and paying taxes, then yes, you should keep doing that. I mean, if it's a company that is still operating in existence, then you need to keep doing that. Most companies, if they stop, or if they want to stop, or if it's not going to be used anymore, you have to file a final tax return with a, you know, just like a dissolution statement. But you should definitely get a tax accountant or CPA, you know, to answer those specific questions for that.
Wonderful. Thank you again, Diane. That's all the questions we have today.
Okay.
We appreciate your time and your great presentation and information. We hope everyone has a great weekend. Thank you.
Thank you so much. Goodbye, everyone.